The stock market is an essential component of the global economy, and it's been very volatile lately. If you are an investor like myself, you've probably been thinking, when are we going to get a break here? If it's not the issues with the banks, it's the inflation concerns, and pretty much everywhere you turn, there seems like there's another reason for us all to run for the hills. But what if I told you that there's an opportunity here in the stock market for long-term dividend growth investors, in which we could potentially change the complete outlook of our lives? In this video, we're going to talk about how a market downturn can cause the starting yield of SCHD to increase significantly and what that could look like for your future and your portfolio. Let's first talk a little bit about SCHD ETF. So SCHD ETF is also known as the Schwab US Dividend ETF. It's an ETF that invests in US companies with a history of paying dividends. The fund's objective is to track the performance of the Dow Jones US Dividend 100 Index, which is made up of 100 high dividend paying US stocks. SCHD has a low expense ratio of 0.06%, making it very attractive for long-term investors. So now you might be asking, what does SCHD and a potential massive market downturn mean for your dividend portfolio? With SCHD ETF now trading somewhere in the low 70s, down significantly from the low 80s, the dividend yield, the starting yield of the ETF, is continuing to rise. To understand this though, it's important to understand the concept of a dividend yield. Dividend yield is the ratio of the annual dividend per share of a stock or ETF to its current stock price. For example, if a stock pays an annual dividend of $2 per share and its current stock is $40, a dividend yield of 5% is calculated, or $2 divided by $40. Now, SCHD is an ETF that invests in US companies with a history of paying dividends. Some of their top holdings include things like Broadcom, Cisco, Texas Instruments, Verizon, Merrick, Lockheed Martin, Pepsi, Coca-Cola, Home Depot, and International Business Machines. Now, what's cool about SCHD's entire portfolio and all their holdings, in my opinion, is that some of these stocks have much more of a dividend growth strategy, and some of the names are just higher starting yield, but don't necessarily grow their dividend as fast. This gives the ETF a nice mix and diversifies the ETF, giving the investors of SCHD a starting yield that would be much higher than the S&P 500, but still cultivating an ETF with a dividend growth rate of around 13 to 14%, which is astounding. With SCHD currently trading in the low 70s, the starting dividend yield is somewhere of around 3.5% more or less. But if SCHD were to continue to go down with the rest of the market, let's just say, over the up and coming days, weeks, and months, we could easily see a starting yield of 4%, 4.5%, or even 5% starting yield. Now, this increase in starting dividend yield for a fund like SCHD could be a significant driver for your overall portfolio, and also is only going to allow your portfolio to compound that much faster. With a high starting yield and a high dividend growth rate, if you think about a situation where SCHD has a starting yield of over 4 or 5%, let's just say, with a dividend growth rate of around 14%, this ETF would make your portfolio snowball at a very, very fast rate. Now, here on the screen, you can see a dividend growth calculator, where we can visualize and input the potential scenarios for SCHD. With an initial $10,000 investment and never investing another dollar into the portfolio, a dividend growth rate at 13.74%, which is SCHD's trailing 5-year dividend growth rate, and a current starting yield of around 3.5%. The first year of investing into SCHD, you would receive around $350 by year 5 just by reinvesting your dividends, not adding in any other outside money. Just letting the starting yield and the dividend growth rate do its thing, you're up to $670 per year in dividends. Now, the craziest part of all is by year 25, you would be at around $23,662 of dividends per year. And again, this is not by adding any extra money, just by reinvesting the dividends. Now, if we were to leave everything else the same, but change the starting yield of 5.5%, which is what I think we could easily see SCHD reach in a severe market downturn like lots of analysts are calling for this year, we would have the same initial investment of $10,000 with $550 earned on year 1 from dividend income. By year number 5, we'd be at over $1,100 per year. Now, what's really crazy is by year 25, remember the starting yield 3.5%, earning around $20,000 or so per year? Now by year 25, you're earning almost $70,000 per year in dividends, just by allowing SCHD's starting yield to be moved up a little bit higher due to a market downturn. And this is the power of buying into a high quality growing ETF like SCHD during a market downturn. Now, of course, do we know for certain that SCHD is going to drop down to 60, 50 or below and actually have a starting yield of 5.5 or even higher percent? Of course not. But this is a theoretical situation, and with everything that's been unwinding lately in the markets, I honestly wouldn't say it's completely off the table. But I want to hear from you guys down below. Do you think we will have a sustained market downturn this year? And do you think we'll see SCHD's starting dividend yield move up much higher from here? If you enjoyed this video, make sure to please drop a like in the video and subscribe for more. Thanks again as always, and I'll see you in the next one.